This is Al Brooks. Thank you for watching the Brooks Trading course. This is the fourth of 4 videos on trading in trading ranges. Experienced traders can enter with limit orders, buying below bars and support at the bottom of the range and selling above bars and above resistance in the top of the range. Beginners should only be entering with stops. Whenever the market's in a trading range, you have to assume that your trade will not go on for a long time. You need a plan to take profits. When the market's in a trading range, it often tests the open of the session in the final hour or so of the session. And therefore, if the market is above the open, traders should look for a reversal down. If the market is below the open, traders should look for a reversal up. Most traders should not be trading within tight trading ranges, but sometimes experienced traders will do it using limit orders and scalping. Very important to understand that nothing lasts forever. Every trading range eventually successfully breaks into a trend. This is the euro versus the dollar, a 60-minute chart. Whenever you're entering with a limit order in a trading range, buying below bars in the lower half, selling above bars in the upper half, you have to use a reasonable stop. Sometimes the stop will be very far away, but you have to use a stop that makes sense. Otherwise, you will lose money. For example, let's say you see a pretty good rally here, a couple legs down. You buy with a limit order at the low of this bar. Where does your stop go? Do you put it right below this low? That's reasonable, but it's probably also reasonable to put it below this low, or even better, below that low, or possibly even all the way down here. Because sometimes when the market is in a leg in a trading range, it can extend much further than what you think is likely. For example, look how high up that rally went before it reversed. Look how far down the sell-off went before it reversed. Reasonable choices. If the market is in a bull leg, it probably will not fall below the bottom of this very strong reversal up, or below the bottom of this even stronger reversal up. Therefore, it's reasonable to put a stop right below that low or this low. You could put a stop right below here, but whenever you have a relatively tight stop, the odds of getting stopped out are great. Especially when the market has a lot of trading range trading. If you put a stop too close to the top of the leg, there's probably better than a 50-50 chance you're going to get stopped out, because pullbacks can be very deep. We have a bull leg using a stop too high up, for example, in the middle of the range. That is not a high probability way to trade it. You need a wider stop usually to allow for a very deep pullback. One way to look at it is the market's in a small trading range here. It's getting a bear breakout. If it's going to be the start of a bear trend, then the bears probably will make a measured move down. A measured move based upon the height of the range is to this brown line. And therefore, since you believe the market's in a trading range and not a trend, you have to assume the bears will be disappointed selling fairly low in the range, in the bottom half of the range. And therefore, it should not reach that brown line, and putting a stop below it makes sense. It also makes sense because it's in the neighborhood of these other two reasonable locations for a stop. You have to look for reasons to take profits. You're buying in the bottom half. You want to be selling out and taking profits in the upper half because you know the odds of it continuing up in a bull trend are small. You look for reasons to take profits once you're near the top of the range, near a prior major high. And here we have a spike and channel pattern. So spike, pullback, and then second push, third push. It's a wedge top. It's a consecutive top. The bears had a wedge top here. It failed. And now they have another wedge top here. High probability that the market's going to have at least a couple legs down, one pullback two or one pullback two. Therefore, it's reasonable to exit on the reversal down from the wedge. Bears will sell above prior highs in the upper half of the range. A reasonable stop is above the top of this very strong reversal down, a micro double top. Very strong rally, very strong reversal down from above the top of the range. First leg down, tight bear channel. That means there's probably going to be a second leg sideways to down, even if there's a big pullback from this first leg down. Therefore, traders will look to sell, for example, at a prior high, use the appropriate stop above the top of the sell-off, and scale in higher. 2 legs down, 1 pullback 2, a micro double bottom, strong breakout here. Expect at least a small second leg down. The bars are getting small and sideways. We're getting late in the session. This is the euro versus the dollar. It's reasonable to look for a reason to take profits, especially now that we're in the bottom half of the range. We're also near the bottom of the bull breakout, and that is the support area as well. Micro double bottom, exit above the high of that bar. Betting that the market is going to enter a tight trading range for 10 or 20 or 30 bars. Also, toward the end of a session, it's always reasonable to take profits if you're looking to exit at some point during the day. If a bull does buy at a prior low, at that low, at this low, at this low, many bulls will buy more lower. When you add to a position, you increase your risk. You're also increasing the chances of making money because you're adding to a position and you do not want your risk to be any greater than on any other trade. If you're scaling in, you have to trade small. You have to make sure that the risk on the entire trade after you've done whatever scaling in you're going to do is acceptable, that it's no bigger than the risk on any other trade. Minimum scalp size in the Forex market is 10 pips. Here, the legs are more than 50 pips. Some of the legs are over 100 pips. Therefore, you should be looking to scale in more than simply 10 pips below. For example, you might scale in 20, 30, 40, 50 pips below your first entry. For example, let's say you bought at this low. This rally is about 100 pips tall. You're already buying about 30 or 40 pips down. You might buy more 20 pips lower, which is around a 50% pullback of the rally. Plus, it's a third leg down. 1 pullback, 2 pullback, 3, a wedge bull flag. Higher probability of getting a second leg up. Therefore, you take that buy. If you take it, you can scale in more, 20 pips lower, and then either get out of the entire position at your first buy, making 20 pips on the lower entry and getting out break even on the second, or hold for a move up to some other resistance level, like 1 pullback 2, a leg 1, leg 2 move, or test near the top of the range. Here we got a wedge rally. If you did buy and buy more here, I think you'd have to get out below this wedge rally, second leg up, 1 pullback 2 in a trading range. Instead of buying more 20 pips down, if you have a pretty good reversal up like this, some traders would buy more here as long as the entire position does not create more risk than they would have on any other trade. Most traders, when they're scaling in, only want to add on once, but some will add on 2 or 3 times. If they are planning to add on several times, they have to keep their position size small because they don't want to risk more on the trade than they would on any other trade. Trading ranges are very forgiving to traders who can use wide stops and scale in, but they have to be able to manage the trade properly. By forgiving, what I mean is there's a high probability, a very high probability, that traders can make money or certainly avoid a loss if they manage the trade properly. Even if you sold at the very low of this bar, the very bottom of the range, betting that this bear breakout was going to get followed through, and it immediately reversed up, if you manage your trade properly, you usually can avoid a loss, if not make a profit. For example, you could sell more at a 50% retracement of the sell-off. Here's the sell-off, here's the 50% pullback. You could sell more there, or you could wait for some kind of a double top with a bear bar and sell more below the bear bar. So you could sell more here. This is the midpoint of your 2 entries. If you sold here and sold more there or here, this is the average entry price. You could exit here and avoid a loss, even though you sold at the very low of a bear trend and the market's reversing up reasonably forcefully. You can still avoid a loss if you manage the trade properly. Even if you buy at the high, at one point this bull doji was a bull bar up at its high. Even if you bought the very highest price, you could still make money 80% of the time, or at least avoid a loss 80% of the time. If you can manage the trade appropriately, that means use an appropriate stop and scale in lower. For example, here's a rally from this low to that high. Here's a 50% pullback. You could buy more with a limit order at 50%, or you could wait for a strong reversal up like this bull bar and then buy above a pullback. If you bought at that high tick and bought more here, this is your average entry price, you could get out without a loss. The market went to your average entry price, allowing you to get out without a loss. The market's in a trading range. You have to have a plan to take profits because you know the odds are it's not going to become a trend, and whatever trade you have is not going to be good forever. It's going to reverse. When the market's in a trading range, most traders are thinking about scalps. In this range, the legs were 30 or 40 bars, 30 or 40 bars. There's enough room for a swing trade. However, you don't have to hold for a swing. You can scalp. As long as you hold for a reward that is 1 to 2 times your actual risk, and you go for a reward that's at least as great as a minimum scalp, which is 10 pips, the math is okay to exit. If the setup that you're buying is a high probability setup, you can exit with just 1 times your actual risk. If the setup is an average setup, not particularly strong, then the probability of making money is about 40%. To make the trader's equation positive, you have to exit with at least 2 times actual risk. No matter how you exit, you need at least 10 pips profit to make a trade worthwhile. You should never enter any trade with the goal of taking less than 10 pips profit. I talk about the math of that in other videos. It's very difficult to make a profit if your goal going in is to exit with a profit of less than 10 pips. A lot of times you will exit with less than 10 pips, but that cannot be your goal going in. If you enter a trade and after a bar or 2 or 3, you're disappointed by what the trade is doing, then you get out. Sometimes it's with a 1, 2, or 3 pip profit, sometimes with a 1, 2, 3 pip loss. That's okay. The minimum that you need to make the trader's equation profitable is a reward that is at least 2 times actual risk for an average trade. For a high probability trade, only 1 time actual risk. But like anything in life, having the goal of achieving the minimum is rarely ever a good idea. You want your kids to grow up hoping to make minimum wage? Of course not. Let's say you bought at that low, you got filled here. And let's say you bought more 20 pips lower right here, the middle of the 3 pink lines. Once the market started to turn up, you knew that your actual risk was only this big from the middle line to the bottom line. And therefore, theoretically, you could exit at the top pink line, 1 times actual risk, if you thought it was a relatively high probability trade. It's far better to exit with more than such a tiny profit and instead, at a minimum, try to get out, break even at your first entry, and then with a profit on your second entry. Remember, the second entry is 20 pips below the first, and therefore you'll get out with a 20 pip scalp on the second. Or you could exit part here and swing the remainder, hoping for a couple of legs up. You could also try to get out at 1 or 2 times your actual risk based upon your first entry. You bought here. Once the market fell here and reversed up, you know that your actual risk was 1 pip below the low of the pullback. And this is 1 times actual risk. I usually base the 1 times actual risk on the low of the bar. The actual risk is actually 1 pip below that, but it's just quicker for me to use the low of the bar. And this is 1 times actual risk, and that's 2 times actual risk. The math is always okay on any trade to exit at 2 times actual risk. When a trade is fairly high probability, once it starts to reverse up, this is fairly high probability. It's always okay to get out at 1 times actual risk. By fairly high probability, that means you believe 60% or better that the trade is going to go your way. With this kind of a reversal, a 50% pullback of the rally, a higher low major trend reversal, a wedge pullback, a decent buy signal bar, we're probably going at least up for a couple legs, and therefore it's a high probability trade, and you could exit at 1 times your actual risk. You bought here, your actual risk is to just below the low of this bar, 1 times actual risk is here, you could get out there. However, with a reversal up that strong, with 2 legs up likely, it's probably better to take partial profits at 2 times actual risk, or simply wait until there's a reasonable reversal and then exit on the reversal down. Traders see that these legs up and down are 100, 150 pips tall. Therefore, if they have a decent reversal like this, especially when it's accelerating up, most traders are not going to just scalp out for 20 pips. They'll try to swing part, if not all, until there's a reasonable top, reasonable reversal setup. For example, a spike, wedge, a spike in channel, testing the top of the range. Some traders would look to sell below a bear bar or sell the close of a bear reversal once they have a wedge top near the top of the range. First leg up, likely to get a second leg up, and the second leg up was a wedge, 1 or 1, and then 2, 3. When the market's in a trading range, and let's say you're day trading, you have to assume that if the day has not clearly become a strong trend, it'll probably try to test near the open later in the day. This is a daily chart. What do you notice about the daily chart? Look at all these bars highlighted in pink. A lot of them have prominent tails and a lot are closing near the open. And what does that tell you? That tells you toward the end of the day, if market was up and went down to the open was a magnet. For example, here's the open of the day. This is the euro versus the dollar, a 15-minute chart. And this is the close of the day. This would correspond to a daily chart, one of the bars up here on the daily chart. What do you notice? The close of the day is near the open of the day. The market tried to break free of it, tried to break free of it again, and the market got pulled back by the gravity of the open. Also, late in the day, what do you notice here? The market got pulled back to the open. The bulls tried to break free and get a new high. Instead, it got pulled back to the open. It got pulled back to the open repeatedly. At the end of the day, it looked like one of these days. A small bull body, close above the open, but prominent tail on the bottom, prominent tail on the top, and a close near the open, a doji day, like the majority of the days here. The magnetic pull of the open of the day is greater if late in the day the open is in the middle third of the day. Here we traded above the open, we traded below the open, and at this point the open is in the middle third of the day. That has a higher probability of pulling the market back to it late in the day. And therefore, you have to be looking for a reversal up from this sell-off and bet against this being a bear trend day and betting that it's going to be like the majority of the days on this chart, a day that closes around the open. Here's the open of the day. Here's the close of the day. If the market goes far above the open, you have to assume it's going to get pulled back down toward the open late in the day. And the opposite is true down here. If you're selling off for the first half of the day, with most of the days being trading range days, you have to assume today will probably have a reversal. It'll probably be a reversal day. So sells off for a few hours, you have to assume it's going to rally for a few hours. Most reversal days end up as trading ranges, not as trends. Here we rallied and we sold off, so it was a bear reversal. We sold off and we rallied, and then there's a bull reversal. Reversals usually result in trading ranges rather than opposite trends. Sometimes you'll get an opposite trend, but most reversal days are trading range days. Look at this day. Pretty remarkable. Here's the open, here's the close. The market sold off early, so traders assumed it'll come back and test the open. And then we had a huge move up here, probably on some news item or a report. But with the majority of the days on the chart closing near their opens, you have to wonder. You look at this and say, oh, we sold off, we rallied strongly, but the open is in the middle third of the day. Therefore, this strong rally might fail and the market may come back down toward the open late in the day. That makes you more willing to sell a reversal down. With the close near the open, a sell-off, a rally, sell-off creates a tail on the bottom of the bar from the open down. The rally created a tail on the top of the bar from the high of the day down to the close, and the day ends up looking like this, a doji bar, just like so many of the other bars. Even with this very strong rally, you look at the daily chart and say, a lot of the days are closing near the open, and even the ones that don't, the market reverses on the next day. When the market's late in the day and it's below the open, traders will look for a reversal back up to the open. Here we got it, and here we got it as well. And the opposite's true. If the market is above the open late in the day, you have to be betting it's going to reverse back down toward the open. The open is a magnet in a trading range day, and a lot of the days try to be neutral by the end of the day, even if they have strong trends during the day. And by neutral, that means the market tries to close near the open, and you end up with a bar on the daily chart that has a small body and prominent tails. Most traders should stop trading when the market is in a tight trading range, but some experienced traders will trade for scalps. A trading range is a channel. It's a horizontal channel, but it's a channel. Like all channels, it can be broad or it can be tight. For example, here it's broad, legs up and down, lasting 10 or 20 bars, covering 25 or 30 pips. When you have a leg like this, you have a double top, a weak rally, reasonable to sell, try to get a swing down. Double bottom here, slightly lower low double bottom, maybe a wedge. 1, 2, 3, reasonable to buy above a good bull bar, hoping for a swing up. The entire range here is pretty small. It's only 30 pips tall. So a swing up might be 20 or 30 pips, not 50 or 100 pips. But if this were a daily chart, this might be several hundred pips and you'd be looking for a much bigger total profit. But in terms of relative to what's going on, it's the same idea. You're selling high, looking for a swing down. You're buying low, looking for a swing up. And you can enter with stops because the legs up and down last a lot of bars and are several times bigger than the average bar. On the other hand, look at this. Here, the range is only 10 pips tall. When the range is tight like this, most traders are not going to trade at all. They'll simply wait. Even with a leg down like this, lasting 10 bars or so, the range is only 10 pips. Even really good scalpers won't bother trading this most of the time. They might buy it this low. If they did, it did not even go up far enough for them to make a scalp, probably. Remember, it has to go 11 pips above your entry price to make 10 pips. It has to go 1 pip above your entry price, and this might not even be enough. When one session ends in the Forex markets, the market often becomes very quiet, enters a very tight trading range for an hour or two between sessions. And when the range is very tight like this, it's a limit order market. If you are going to trade it, you have to be trading with limit orders, selling at prior highs, buying at prior lows. When the range is this tight and the bars are only 3 pips tall, I think it's not worth trading. This is actually a fairly tight range, even though it has a lot of bars and the legs up and down. And a lot of traders would simply scalp this for 10 pips. This is extremely tight. When I see this, I'm not trading. I just wait. I wait for the next session, assuming I'm still trading at that time. I have some guidelines that I use when I'm deciding whether or not to trade. I want most of the bars to be at least the size of a minimum scalp. This is the euro versus the dollar. It's a 5-minute chart. I want most of the bars to be at least 10 pips tall, and they are not here. I want the height of the trading range to be either 3 times bigger than the average bar or 3 times bigger than the smallest scalp. That is true here. The range is about 30 pips tall. Here it is not true. And based upon that alone, I would not be trading in here. I would just wait. The trader who does want to trade this has to be trading with limit orders. You sell with a limit order near the top and you scalp. For example, you might sell with a limit order above a prior bar's high, like above this high, or you could sell a strong bull close, betting that the bull breakout attempt will fail and the market will reverse down, and do the opposite toward the bottom. You buy the close of strong bear bars here, here, or here, hoping that the market will go 11 pips above your entry so that you could scalp out with 10 pips. You could sell the close of that bull bar. You could sell at this prior high and then place a limit order to get out 10 pips below. It did not reach your limit order here and it reversed back up towards your entry price. A lot of traders would exit around break even. Sometimes you'll get a high one bull flag at the top of the range. For example, here we have a bear bar pulling back from this bull reversal. You could sell with a limit order at the high of that bear bar, taking a chance that it's a bad bull flag and therefore more sellers than buyers above. Sometimes you'll get a reversal down at the top of the range with a decent bear bar and you can enter with a stop. Sometimes you'll get a reversal up at the bottom of the range and the bar is not particularly big. You can buy with a stop above its high. This range is so tight that I would never be entering with stop orders. If the range is only 10 or 15 pips tall and you're entering with a stop, you're already entering 5 pips or more from the extreme of the range. So if you're buying above here, you're already buying 5 pips above the low, and the top of the range is only 10 pips above that. So entering with stops in a very tight range, the math is horrible. You should never do that. Same thing, selling below a bear bar near the top, buying above a bull bar near the bottom, entering with stops. It's almost impossible to make money. When the range is as tight as this one is, it's very difficult to make money even with limit orders. Buying with a limit order, buying at that low, using maybe a measured move down for the stop or put a stop below this low, and hoping that the market will go 11 pips above your entry price. You buy at this low with a limit order, you get filled here. It has to go up 11 pips for you to make money. If you have a bull bar near the bottom of the range, buying with the stop, you're risking too much for the probability that you have and for the potential reward. It's a terrible strategy. Entering with stops in tight trading ranges, selling below bear bars at the top, buying above bull bars at the bottom. When the range is this tight, you will lose money, so do not do it. If you're a beginner, you should only be entering with stops. Since it's a losing strategy in a tight trading range, you should not be taking trades when the market is in a very tight range. Had you bought with a stop above this bar, you probably would get out below a bear bar, either below this bar, below that bar, or below this bar, a small double top bear flag. You'd get out around break even after holding for about 10 bars. That's a lot of work for very little profit potential, and you have the risk of losing 10 or more pips if your stop gets hit. No matter what strategy you use when the range is this tight, you're not going to make money. When the range is very tight like this, do not trade. Trading range, you trade it like any other limit order market. Bulls are looking to buy strong bear bars near the bottom, and bears are looking to sell strong bull bars near the top, and they're going to scalp out a limit order market. That's what limit order market means. It means you'll rarely get decent stop order entries. Here we got a double bottom, decent bull bars, stop order buy, stop order sell. But in general, I'm looking more for limit order sells at the top and limit order buys at the bottom, and then scalping out in the middle of the range. A lot of traders will scale in and use wide stops. For example, strong bull bar in the upper half of the range, strong bull bar, upper half of the range, strong bull bar, upper half of the range. Traders will sell that close, they'll sell that close, sell this close or that close, and put a stop maybe a few pips above the top of the range and look for a 10 pip scalp. It has to fall 11 pips below your entry price to exit with a 10 pip scalp. Other traders will sell at prior highs. When the market is going up, they have a limit order to sell at this high and they get filled right here. The market's going up, they'll sell with a limit order at this high or at this high, and they'll get filled right here. Again, looking for a scalp, a 10 pip scalp. Some traders will scale in higher, betting against the market becoming a bull trend. So if they sell here, they might be willing to sell 10 pips higher. Here, the breakout was not big enough for the bulls to scale in. Other traders will sell with stops on reversals down, but when the range is tight like this, 30 pips, I'm more interested usually in limit orders if I'm going to trade it at all, because I don't want to be selling below a big bear bar. Then I'm selling in the middle third of the range. Too much risk, the market will just go sideways instead of down. My risk is too great, my profit potential is not great, and my probability is not all that good. So selling with stop orders in the middle of the range, buying with stop orders in the middle of the range, usually not a good strategy. Some traders like to sell with limit orders above bad bull flags. If you see these two dojis, we're now in the top half of the range. We're near resistance levels. The market sold off here, 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 around this price. Some traders will sell with a limit order at the high of this bar, thinking that it's a bad bull flag and therefore bad for bulls buying with stops, maybe good for bears selling with limit orders. The same here. Top of a tight trading range, we have a reversal up. Traders might sell above the high of the buy signal bar, either this bear bar or that bull bar, betting against a rally and betting that there are more sellers above than buyers. They'll bet that it's a tight trading range and that every reversal up will fail. They'll bet that every attempt to break to the upside will fail and reverse down. They're betting there will be more sellers than buyers, more limit order traders selling than stop order traders buying. If you're looking to buy, it's usually better to be buying with limit orders below prior lows, betting that the bear breakout will fail. So you buy here, or you buy at this low here, or this low, and you get filled there. You buy here, even with the strong sell-off, betting that the day will remain a trading range day. Big up, big down, usually a trading range day. Big down, big up, probably a trading range day. Big up, big down, probably a trading range day. You have to assume big up again, and the market is likely to continue like that for the remainder of the session. Some traders will buy at a prior low. Other traders will say, well, there's room down to the low. Maybe rather than buying at this low, I'll buy 10 pips below, betting that the breakout will fail and the market will come back above the breakout point. And that's a pretty good strategy. The difficulty is sometimes it doesn't go down far enough for you to get your entry. For example, if a trader chose to not buy at this low, not buy here, instead put a limit order to buy 10 pips below, betting that the rally will come back above the breakout point here, he would never have been filled because it did not fall down. So the traders who are not buying at the lows and instead of trying to buy 10 pips lower, very often they never get filled. For example, a bear selling at this high, he might instead decide to sell 10 pips above the high because he wants the market to be very overbought before he sells. If he had an order to sell 10 pips above this high, he never got filled. Buy a reversal up, especially a second entry buy. first entry, second here, decent bull bar, far enough down, probably room for a profitable trade. Here we have a lower low. You can call it a lower low major trend reversal, bear trend, bull breakout, lower low. You can call it a double bottom, a slightly lower low double bottom, a reversal up from a failed breakout below a trading range with a decent bull bar. All good reasons to buy with a stop. Whenever the market has a lot of trading range price action, a lot of bars with prominent tails and small bodies, lots of reversals, and then they see a breakout, especially when they see the biggest bar in 10 or 20 bars, they're going to bet that instead of the market successfully breaking into a trend, it'll reverse, that it's a trap, trapping traders into selling low. Experienced bulls oftentimes will buy at the close of a strong bear bar at the bottom of the range. They see the breakout below this, breakout below that, extremely big bear bar late in the trend, more likely an exhaustive end of the trend than the start of a new bear trend. And the same is true here as well. A lot of the bulls, when they see that big bear bar at the bottom of the range, they'll simply buy the close. And the bears do the opposite. If they see strong bull bars near the top, they'll sell the close. We have a strong bear breakout and a pullback, and therefore it's a low one bear flag. A lot of traders will say, we have a bull bar here. That's very bad for the bears betting on a successful breakout. And then we have a pair of dojis, again, bad follow through. This is probably a bad bear flag. Therefore, there are more likely limit order bulls buying at the low of the sell signal bar than there are stop order bears selling 1 pip below the low. So the bulls will place a limit order to buy at that low, betting that we may not come down to a new low. Remember, bulls are looking to buy new lows when there's a lot of trading range price action. But when you have a sell climax like this and a decent reversal bar like that, traders think that this might be the low for the next 10 or 20 bars, and therefore, if they place a limit order to buy at this low, they might not get filled. Therefore, some of them will buy the breakout below the bear flag instead of waiting to see if the market breaks below the low of the bear trend. Everything eventually ends. Every trend eventually becomes a trading range. Every trading range eventually becomes a trend. Traders have been making money for 50, 60, 70 bars, looking to buy low, sell high, and scalp. They're betting on a continued trading range. They're betting that breakout attempts up and down will continue to fail. They know that eventually there will be a successful breakout. Bears might sell a strong bull bar at the top, betting that the bull breakout will fail. Other bears will sell on a stop on the reversal down. And bulls will do the opposite. They see a breakout below. They'll bet that the breakout will fail, just like this sell-off failed, this one failed, this one failed. They'll take a chance that this one will fail as well, and they'll buy with a limit order at that low. And some of those bulls will be willing to scale in lower. We have consecutive bear bars here, both closing below the trading range. That is likely to have at least a small second leg down. When traders see that, they'll begin to suspect that this will be a successful measuring gap and that the market will fall for at least a measured move based upon the height of the range. It's a fairly tight range, 10 or 15 pips tall. Once traders see the bear close below the range and a second consecutive bear bar closing near its low, they'll start to think that will probably fall for about a measured move down based upon the height of the range, which would be somewhere down here. And if you're a bull who bought this limit order trade at the prior low and you see the consecutive bear bars, you're probably going to be disappointed. And if you're an experienced trader, you'll decide the trade is no longer going to work. It's no longer a trading range. We have consecutive bear bars closing below the trading range, both closing below their midpoint, one closing on its low. The market's probably going down for at least a small second leg. Had you bought here, you probably are going to exit here. These two bear bars closing near their lows are a sign that the bulls are giving up. and they're also a sign that the bears are taking control, and therefore traders are going to switch from trading range trading, selling high and buying low, to trend trading, selling for any reason, including selling low, betting that the market will go lower. They'll sell above bars, they'll sell below bars, they'll sell bear closes. If you're an experienced trader and you are buying with limit orders at the bottom of a trading range, you can only do that if you can make quick decisions. You have to know when you're probably wrong. And consecutive decent-sized bear bars closing below their midpoints, closing near their lows, the market is probably going to have a successful breakout. If you bought here, you have to be able to get out here and take the loss. You cannot be in denial and hope that the trading range will continue. If it does continue, fine, you can buy later. But by the close of this bar, especially after a tight bear channel and then consecutive decent bear bars both closing below the range, you have to assume the odds are the market's going at least a little bit lower, and this could be the start of a spike and channel down. Spike, pull back, and then channel down. You have to get out. And a lot of traders cannot do that. They cannot buy here and then get shocked by the two bear bars. A lot of them will hold on hoping that it'll be a failed breakout and the market will come back up and allow them to exit without a loss. You cannot do that because this is probably going to lead to some kind of a measured move down. And that means you're probably going to lose money, and therefore you should get out and take a small loss instead of getting out later and taking a big loss. Once you see this second bear bar, the market's always in short. You have to get short. You certainly have to get out of longs. When the market's in a very tight range like this and it lasts for 20 or more bars, 50% chance there's going to be a breakout either up or down. 50% chance the first breakout will fail. We're breaking out to the upside, 50% chance it's going to fail. We're breaking to the downside. Theoretically, at this moment, 50% chance the breakout's going to fail. And once you have two consecutive big bear bars, especially after a failed bull breakout, 60% chance you're going down for at least some kind of a measured move. Once the odds are it's starting to trend, you have to stop trading like a trading range. You have to start trading it like a trend. Sometimes the breakout can be a huge bear bar. Usually it's a pair of bear bars. Sometimes it's a series of small bear bars, 4, 5, 6 small bear bars in a bear microchannel. You can see the video on trading breakouts for examples. Experienced traders can enter with limit orders, buying below support at the bottom of a trading range and selling above resistance at the top of the trading range. Only experienced, consistently profitable traders can do that. Beginners should only be entering on stops, looking for a reversal up from the bottom to buy or a reversal down from the top to sell. Trading ranges resist breaking out, and therefore you have to be taking profits. You cannot be hoping that the trading range is going to convert into a trend. Whenever there's a trading range, the open is a magnet toward the end of the day. Therefore, if the market is above the open, look for a reversal down. If the market's below the open, look for a reversal up. This is especially true if the open is in the middle third of the day, and especially if a lot of the bars over the past week or two have prominent tails and have closed near the open. When a range is very tight, beginners should never trade. Experienced traders will sometimes trade if the range is at least 20 or 30 pips tall, and they're usually buying with limit orders in the bottom third and selling with limit orders in the top third. Many of them will use wide stops and scale in. Every trading range eventually breaks out into a trend. If you're a limit order trading and you see a breakout and a follow through, you have to get out of your trade because the market's probably beginning to trend, and trend traders will start trading in the direction of the new trend. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 4 videos on trading in trading ranges.